Good. So, product of the day is Carrier's Legal Liability Insurance. Carrier's Legal Liability Insurance. You have to confirm to me whether the presentation is visible and my voice is audible. Anybody can confirm?
Fine, sir. Repeat, sir.
Okay. So let's continue.
Yes, sir. Please.
The Carrier's Legal Liability Insurance is one policy which is normally required for the transporters, logistic firms, and carrier firms. That means they are the people who are engaged in the business of transporting the goods from one place to another place. And if you have to send some goods from one place to another place, you will first explore the options available with you. And options available with you are, you will think on it whether to send it by sea route, by air route, by rail route, or by land route. Because the conveyance or the mode of the conveyance are available all the way. If you are selecting the sea routes, that means your goods will be transported through ship, vessels, boats, steamers, or any hull. Hull means waterways machinery. If you are selecting the air route, that means your goods will be transported through air carriers, helicopters, or any other air device. Air device means any advanced technology. Say for example, nowadays some goods are delivered through drone also, but that is a little amount of the goods. And the maximum goods is transported through the railway routes. So for that purpose, railways have special wagons and special trains. Means there are special trains which are called as the goods train or mal gadi, what you call. So obviously they are used for the transportation of goods only. But we are concerned with the roadways. Roadways means any vehicle used for carrying goods through road route from one place to another place is the subject matter of this insurance. Because this Carrier's Legal Liability Insurance will cover only the risk of the vehicles used for transportation through road routes. These vehicles are called GCCV, that means goods carrying commercial vehicles. These vehicles could be of different name, for example, light commercial vehicles, medium commercial vehicles, heavy commercial vehicles. These vehicles could be of different shapes, for example, tankers, refrigerated vehicle, open body, closed body. But they are all insurable under the Carrier's Legal Liability Insurance. So, to be very specific, this policy is concerned with the vehicles used for transportation through road routes only. Neither waterways, nor airways, nor railways. They are not the subject matter of this insurance policy. Now, why Carrier's Legal Liability Insurance is required? Because whenever there is a movement of goods, or cargo, or merchandise from one place to another place, there is a possibility of being damaged during the transportation. Obviously, when the goods is carried through the vehicle, journey may be long or short, but anything can happen on the way. So the possibility cannot be ruled out, possibility of loss or damages. Now the question is, if goods are damaged in transit, means en route, the owner of the goods or marine insurer, in case of subrogation under marine policy, may sue the transporter for the losses. Say for example, if you are sending your refrigerator from Bangalore to Chennai through a transporter. Now when the vehicle was going in transit, your refrigerator got damaged. Now when you came to know after reaching the consignment at the destination, Chennai, you found it in the damaged condition. So obviously you will sue or you will file a claim on the transporter because you have paid the freight. It is his duty to compensate you if it is not safely delivered at the desired place. In a simple manner, this is the duty of the transporter to compensate if any goods or cargo is damaged during the transit. But there are some wise people who prefer to take insurance before transporting their goods, or maybe they are transporting in routine. There could be firms like business units, daily suppliers, grocery items. They are in routine supplying their goods or sending from one place to another place. So they may have the insurance policy for that purpose. Insurance policy is to provide the financial compensation, not to stop the loss. If an accident has to happen, it will happen. Insurance company cannot do anything. If a fire has to occur during the transit, it will occur. Insurance company can only compensate. So suppose if any goods or cargo is damaged during the transit and it is insured from the insurance company, what the insurer will do and what the owner of the goods will do? Owner of the goods will first prefer to file a claim on the insurance company to take the compensation for loss or damages. It is the duty of the insurance company to pay the compensation because the goods have been damaged and they have insured the risk. Now the question is, once the insurance company has paid the claim, they will ask for the subrogation letter from the owner of the goods. And on behalf of that subrogation letter, they will file a case against the transporter because he is the ultimate person who is responsible for causing the loss or damage to the goods. So this is his duty to pay the compensation either to the owner of the goods or in case of insurance to the insurance company. That means a transporter or a carrier or a logistic firm cannot save the liability in case the goods have been lost or damaged during the transit. They have to pay either to the owner of the goods or to the insurance company. But in such a case, there is only one insurance policy, that is known as Carrier's Legal Liability Insurance policy, that comes to the rescue of the transporter or logistic firm to cover such liabilities. So this is the reason why this Carrier's Legal Liability Insurance policy is taken by the transporter firms. So who will take this policy? Either the carrier or the transporter or the logistic firm who are engaged in the transportation of goods from one place to another place. Now vehicle can be owned or hired because what they are insuring, the policy is insuring only loss or damage to the goods, but goods will be transported through the vehicles. Now all the vehicles which a transporter firm is using for transportation purposes will be listed under the policy. And these vehicles can be owned one, can be hired one. If they are listed in the insurance company's policy, then only the insurance company will cover the risk and pay the loss or damages to the goods which was transported under these vehicles. Now, carrier's legal liability covers only the legal liability of the road carriers for actual physical loss or damage to the goods. Means the policy provides compensation for the loss or damage to the goods only. So the scope of cover is if the goods is damaged due to fire, explosion, accidents, and negligence of the insured or his representative or servant or employees. That's all. This is the cover of the policy. I repeat, carrier's legal liability will pay the compensation in case the loss or damage arises to the goods by fire, explosion, accident, or negligence of the insured or his employee or his representative or his servant. That's all. But there are two additional risks which are available on payment of additional premium. They are known as the add-on covers or the riders, and they are right and strike and terrorism. So these risks can be selected on payment of additional premium, but they are voluntary. That they are neither inbuilt cover nor they are mandatory. They are as per the option of the proposal. So the key considerations of this policy is, first of all, this policy will be given to 1 year only, not for a longer term. It could be for shorter term, but not for more than 12 months. On expiry date of the policy, it can be renewed. It is given to the reputed firms. But the precondition of our company is that all the vehicles used for transportation by the transport firm must be insured under a comprehensive package policy individually. Means motor vehicle has to be insured under a comprehensive policy individually, because individually means one policy will insure only one vehicle. If I am owner of 3 vehicles or 3 cars or 3 bikes, I cannot insure all these 3 bikes under my one policy. Maybe I am the owner. For each vehicle there is a separate policy. So individually each vehicle has to be insured under a comprehensive policy. Our condition is that the policy must have to be comprehensive, because third party liability is covered under the Act only policy also, third party policy also, but that will not serve the purpose. We want insured must have comprehensive policy for all those vehicles which are owned by him or hired by him. Here the important question is, the vehicles hired by the transporter firm cannot be insured by his own firm, because he don't have the insurable interest in those vehicles. So the owners of those vehicles will get the insurance policy and they will submit a copy to the transporter firm. That is a sufficient proof that the vehicle has been comprehensively insured. One more thing, because the policy period may differ of the vehicles and carrier's legal liability insurance. So this is the duty of the transporter firm, that throughout the period of the CLL policy, if any motor package policy is expiring, that should be renewed in continuation. This is because on the date of loss to the cargo, to the goods, if it was found that the vehicle carrying the goods was not comprehensively insured on the date of loss, in that case carrier's legal liability will not pay any claim. So this is a precondition. Then the subject vehicle must be roadworthy condition. Must be in roadworthy condition. Roadworthy condition is not a verbal commitment. It is a proof, written proof, that is issued by the RTO. Roadworthy condition is certified by a fitness certificate. That means the RTO must have issued a fitness certificate to all those vehicles which are used by the transport firm for transportation of the goods. then all his vehicles, either owned or hired, can be insured under single fleet policy. But this is an option. If the transporter has lesser number of vehicles, he can take single policy, fleet policy. Or if he wants individual policy for each vehicle, he can take it. This is his choice. Now, as a transporter, it is his duty to maintain some books related to the transportation business. For example, logbook. Logbook is a book where the entry of all the vehicles is made. On what date, which vehicle went where. So this complete record is maintained in the logbook, vehicle detail. Other one is consignment note for each vehicle. Consignment note is the complete list of the goods carried in a transport vehicle. These two documents are not required at the time of insurance, but on filing the claim for any loss or damages, these documents will be asked for by the insurance company to cross-check whether this vehicle carried the goods or not, whether the goods is in the consignment note or not. So insurance company will cross-check through these documents. Now, carrier's legal liability insurance policy provides cover duration. That is the most important part of this policy. Cover duration means when the risk will commence and when the risk will expire. This is one such policy where the nature of loss or damage to the cargo can take place at any stage. Means at the point of origin, where from the journey will start, at the point of discharge, where the journey has ended, at the point of origin, while loading the goods, at the point of discharge, while unloading the goods. If the goods is not unloaded, it is in the vehicle itself, still the risk is covered. Day 1 it is covered, day 2 it is covered, day 3 it is covered. Fourth day onward, the company will not pay any compensation for loss or damage to the goods transported in a vehicle. That means commencement of cover will start from place of origin. Place of origin means where from the journey will start. If the goods is going Bangalore to Chennai, that means Bangalore is the place of origin. Chennai is the place of discharge or point of discharge or final destination. So the commencement of cover will start from place of origin with the loading of cargo, because the loss or damage can be during the loading operations also. So loading of cargo or goods or merchandise on the vehicle and remain until the same is unloaded at the point of discharge. If it is not unloaded, on expiry of 1 day, 2 days, 3 days from arrival of the vehicle at the final destination, whichever is earlier. So here this policy is providing the comfort of extra 3 days to the transporter firm. That is required for the transporters. Why? Because when the goods has reached or the vehicle has reached at the point of discharge, there is no guarantee that the godown is having the sufficient place to unload the goods. There may not be sufficient space to unload the goods. Goods is still loaded in the vehicle itself. There is possibility of loss or damage to the goods in the vehicle. So this comfort is required for all transporter firms, because they are also not sure. While the vehicle is reaching, loaded vehicle is reaching to the point of discharge, the vehicle will be unloaded on the same day or not. Vehicle will be unloaded on the next day or not. They are not sure. Because from many places transporter firm is connected. So which vehicle has reached first, that will unload. So for such situations, 3 days comfort is enough. Now what are the rating parameters? 3 things are required for rating of this policy. GVW of each vehicle, gross vehicle weight of each vehicle that is mentioned in the registration certificate of each vehicle, because they are all commercial vehicles. GCCB, goods carrying commercial vehicles. The registration will show the detail of gross vehicle weight. Then limit of indemnity. Limit of indemnity means the insured will select the limit of indemnity, what sum he want to insure under the policy. Normally, this is the annual turnover. If a transporter firm has the annual turnover of 1 crore rupees, that they will prefer to take the sum insured of 1 crore. But it is not sure. They may take higher value also, they may take lower value also, they may take same value also. Previous year's turnover will work as the basis, but not hard and fast that the same has to be taken. This is as per the choice of the insured. Then out of that, once it is rated, insurance company has the right to provide the discount and loadings according to the proposal, merits of the proposal, you can say. What are the type of vehicle body? Because vehicles used by the transporter firm of could be of closed body, refrigerated vehicle, tankers. Secondly, what is the fleet? Maybe there are 20 vehicles in his fleet, maybe 50, 100, 200, we never know. It depends upon the business of the transporter firm. Then past claim history, how many claims he has taken in the previous year, if the current legal liability insurance policy of any company was there. So that past claim history will reflect to his moral hazard. Other parameters like age and fitness of the vehicles, types of cargo, they are the considerations for providing the discount in the rating. Policy is subject to compulsory excess. 2% of claim amount subject to minimum of rupees 5,000 for each and every loss will be deducted. In case of terrorism, it could differ. Policy covers the liability as per the coverage of the policy, that is fire, accident, explosion and negligence. But it excludes the third party liability, because carrier's legal liability is covering the risk of loss or damage to the goods only. Third party liability caused by the vehicle which was carrying the goods is not part of the carrier's legal liability insurance. This liability is covered under the motor insurance policy, and for that our requirement is that the transporter must have comprehensive policy for each vehicle. So this is governed by the Motor Vehicle Act. Third party compensation will be settled by the Motor Accident Claim Tribunal. This liability will be decided by the MACT court. This will not be paid by the carrier's legal liability insurance, and this is exclusion of the policy. Contractual liability is again excluded. Goods belonging to servant, agent or subcontractors will not be covered because this is their own goods. Right and strike risk is not covered, but it can be taken on payment of additional premium. Act of terrorism is not covered, but it can be taken on additional premium. Inherent defect or vice is not covered, but there is no add-on for it. Inherent defect or vice means the goods has been damaged without any accident, without any explosion, without any fire. It is damaged due to its own properties. There are certain perishable items which can decay. Perishable means which have this very short life. For example, vegetables, fruits, sweets, items made of milk. But they have the limited life. Their own properties can damage it without any fire, without any accident. So this inherent defect or vice is not covered. Consequential loss is also not covered, means loss of market, it is also not covered. Then, if the transporter firm is not having the required documents, say for example the permit is not proper, fitness is not proper, itself the insurance company will not pay any claim. But if there is any loss or damage to the goods, it is the duty of the transporter firm to immediately intimate the insurance company, because insurance company, after verifying the policy, will send a surveyor at the spot who will physically verify the loss. Loss could be to any extent. To any extent means the entire vehicle, which is fully loaded, can meet with an accident, can burn, can explode. So it is the duty of the transporter firm, who is the insured of the policy, to immediately inform the insurance company, so that the insurance company in a position to send the surveyor, who will rush immediately to the spot and he will verify the loss physically. He will make the detail, he will take the notes, he will verify the documents, and he will assess the loss. On the basis of that, insurance company will settle the claim. But while settling the claim, they will ask for certain documents. And these documents could be different in nature because they are related to the transportation firm. So first of all, a package policy has to be checked. Then the registration certificate issued by the RTO for the vehicle has to be checked. Then if there is any agreement letter between the transporter firm or the supplier of the goods, that has to be checked. Then certificate of registration, which is the authorization for the transportation business by the transport department under the Carriage by Road Act provisions, that has to be checked. Fitness, claim form, GR, good forward note, they are the documents required to settle the claims. Insurance company may ask any or all of these documents to settle the claim. Then if you are giving the carrier's legal liability insurance policy to any of your customers, the bare minimum detail required for giving the quotes to you is this one. Number of vehicles you have to check, GVW of each vehicle, limit of indemnity for each vehicle, insured one-time add-on cover, we have got 2. If you want 2, we can. If you want 1, or if you are not interested, then there's no need. What is the type of body? Whether has the trailers, refrigerated vehicles. What is the age of vehicle that can be taken from the registration certificate? Type of cargo which these vehicles are carrying in routine. There could be a specific cargo. For example, a transporter is engaged in transporting the petrol or diesel. One transporter is engaged in carrying the cement only. One transporter is engaged in carrying the footwear only. So there could be a specific cargo. There could be mixed cargo also. It depends upon the business of the transporter. Then past claim history and the kind of policy he has selected. Whether he has selected fleet policy, the fleet policy will be given. So this is the bare minimum detail which is required on the proposal form for generating the quotes. Once the quotes are generated, they will be given to you and you can show them to the proposer. If he is agreed to it, policy will be issued. Now the question is, normally transporter firms are taking the fleet policy only because no transporter is working on the basis of 1 or 2 vehicles. They may have number of vehicles. Larger is the business, bigger is the number of fleet. And for all those vehicles, package policy of motor insurance is compulsory from our point of view. And we permit any type of cargo carried except the items which are contraband. Contraband means which are not legally permitted. Now there is a difference between the marine transit policy and carrier's legal liability insurance policy. What is that difference? This carrier legal liability policy is a part of liability insurance because this is covering the liability. Marine policy covers property or the goods or the car. This is covering liability because the goods carried by the transporter firm neither belong to him nor belong to that transporter where the vehicle is going at the point of discharge. This is a goods belonging to a third person who has paid the freight, and in lieu of that, he is carrying the goods from one place to another place. So this is a liability policy. And in case of liability, only the person who is responsible for the loss or damage will take the policy. But in marine transit policy, because the goods belong to the owner who is taking the marine insurance policy, and he can take, buyer can take, consignor can take, consignee can take. They are the people who have the right to take the policy. So carrier legal liability policy is different. It is taken by the transporter only or logistic firms only, but marine policy, marine transit policy is different. This can be taken by the owner of goods. When we are giving the carrier legal liability policy, it can be given for the entire fleet of the vehicle, maybe owned vehicle or the hired vehicle. Under insurance is neither applicable to the motor insurance policy nor to the carrier legal liability policy. For motor insurance, it is not applicable because IDV pattern is there. Insured declared value. That is the market value. In carrier legal liability, it is not applicable because transporter firm is not the owner of the goods. They don't know, they never know what is the value of the goods actually. They are aware only that whatever value is given to them by the owner of the goods, they have mentioned that and they are liable for that value only. So liability will be paid on the basis of AOA and AOY. This is the basis. Now both the things are required by the insurance company. So this AOA and AOY will be the sum insured of the policy. Transporter firm which is taking the policy, that has to work out the AOA and AOY. AOA means any one accident. In one accident, what could be the maximum limit of loss? It could be the total value of the goods carried by the vehicle. AOY means any 1 year. In the entire 1 year, what could be the total loss? Say suppose 10 accidents are there in a year. 10 accidents. And in those 10 accidents, the transporter has suffered the loss of 50 lakh rupees. While the sum insured you are taken for 40 lakh rupees only. How the insurance company will pay? So that is typical things. But this is decided by the transporter firm only. They have the choice what sum insured they want to select for themselves. Whatever sum insured they are proposing, that will be accepted by the insurance company and the premium will be charged on that sum insured only. Rate will apply according to the cargo carried. Cargo may be mixed, individual, specific, whatever it is. Rate may vary according to the nature of cargo. So here, this policy is not mandatory, not compulsory by any law. Only thing is, the policy compulsory is Motor Vehicle Act mandates the third party liability insurance policy for the vehicles which are plying on the public place. And because all the vehicles which are carrying the goods are subject to package insurance policy, so they are already insured. This is the mandatory compliance. Carrier's legal liability is a matter of choice. If the transporter firm wants, they can take it. If they don't want, they will not take it. But under any circumstances, the transporter firm or logistic firm or the carrier firm, it is difficult to do the transportation business without carrier's legal liability insurance policy. Say suppose mine is a Jaipur Golden Transport firm. My 10 trucks are going every day, minimum 10. It could be 15, 20, 12, depending upon the goods I have received for transportation. But minimum 10 are going. Out of 10, how I can be insured? How I can assure you that none of them will meet with the accident or fire or explosion? Anything can happen. Once it is out of my godown, I don't know what will happen. Driver is the person who is driving, how careful he is, what is happening in the transit, what is the nature of goods, whether it will reach safely or not, whether it may collide, goods may leak, goods may be stolen. Anything can happen during the transit. So it is difficult to do the transportation business without this policy. Because this is also possible that whatever amount has been earned by the transporter firm during the entire year is lesser than the amount he has paid for the claims for the loss of damage to the goods. This is also possible, depending upon the incidents. Maybe this is also possible that in the entire year there was no accident, there was no loss or damage. This is also possible. Because the people who are engaged in the transportation business, they are using the services of expert drivers, good vehicles, and they are maintaining their vehicles properly. Possibility of accident cannot be ruled out, but as far as possible, they are making all steps to minimize their losses. That is the reason they are running. But still, when they are taking this policy, they are on the safe side, because this policy is providing good coverage to them. And this is the covered duration, which is important from their point of view. If they are getting 3 days extra, they are in the comfort. So this policy for every transporter is required. Once you are entering an office of the transporter firm, you may face the problem that since this policy we have launched just 2 or 3 years ago, but the transporter firm is running since last 10, 15, 20 years. So they are already having this policy, maybe from XYZ company. How will you compete? But if your selling skills are impressive, if your deals are impressive, if your bonding is stronger, and you have entered into his office, you have succeeded in giving this policy, you have one more scope to sell the policies of motor insurance to all his fleet, to entire fleets. Because none of the vehicle can be used in a public place without proper insurance. And transporter firms are taking the comprehensive policy only for this purpose, because they know the cost of the vehicle is very high. If it is meeting with an accident, they have to pay out of pocket. How much expenditure they will bear for it? So they will always prefer to take the comprehensive insurance policy for their vehicles which are using for the transportation purposes. They understand it. So once you are succeeded in entering and selling this carrier's legal liability insurance policy, you have got one more opportunity to ensure they are all the number of vehicles which they are using for transportation purposes. So this is all about the carrier's legal liability insurance. If you have questions, you can ask them. Any questions? Any doubts, any questions? I am open to answer all those. This is good, the policy is clear to you, you have no doubts. It means you are already selling this policy. I understand this policy is clear to you. Just check your mail ID if you have received the test paper. Is it there on your mail?
Received, sir.
Received. Good. You can try attempting it. Do all the 10 questions.